As people are joining, we just want to say welcome. I'm John Mincer, one of the advisors here at Navarre Capital. We really appreciate your time. We appreciate your, sort of attention during this, very important meeting where we want to just go over America's finest companies, the strategy, what's changed. Mostly, Bill Staten leaving has changed, and sort of the advisor roles have changed a little bit. And then for the most part, we want to hand this over to Brando, our Chief Investment Officer, to give sort of a market update and sort of a macroeconomic update as well. So one thing I wanted to start by saying too is we're missing Cindy Bernard. She's a very valued member as well that many of you know. She's on the road traveling to Texas today, visiting some clients, so we're missing her. But let me begin. Again, I'm John Mincer, one of the advisors. We got our bios up here on the page. I've been in this business around 18 years now, originally at E-Trade Financial, Wells Fargo, Bank of America, and then now in the RIA space. Sort of my focus is on portfolio management and planning. And it says here, and it's very true that, planning should be about delivering peace of mind to the client. So that's kind of what I hope to achieve with clients. Now I'll pass it over to Alex Dan.
Yeah, thanks, John. So Alex Dan, I'm a certified financial planner. Been with Navarre now going on 4 years. Spent 7-8 years before that with Fidelity Investments, creating financial plans for the high net worth client group there. And as it says here, just feel really strongly about building good, solid financial plans and helping make sure clients have a strong investment strategy that meshes with that.
So I'm the second John at Navarre, but joined the firm 2 years ago and also a certified financial planner. Before Navarre, I actually operated in the merger and acquisition space in the investment world, which was really good for my career. Allowed me to get a pretty diverse reach on different, households, all different demographics, ages, etc. And so my passion, like the rest of these guys, is helping to build financial roadmaps, whether you're in the early stages of planning, whether you're in retirement, so on and so forth, and just helping families navigate all the curveballs of life.
I'm Brando Reyna. So I know quite a few of you, and it's great to see you guys again and have you guys join us. So as you may or may not know, I've been co-managing America's Finest Companies with Bill. Started in 2017, and when we first, it was interesting, when we first met, it was one of those things where just kindred spirits right off the bat. We felt like we became best friends. And I remember walking out of his building that day, and I felt like a little kid. I was like, "Hey, you want to come over for dinner tonight? My mom's making meatloaf." And we hit it off. And for the last 7 years, we've had a great time. Still keep in touch with Bill, but going forward, the lead PM for America's Finest Companies. So again, to reiterate John's comments, thanks everybody for joining. I know Bill and I used to do a monthly call. This will kind of encompass a lot of those same aspects. If you have any questions, there is a chat box. Feel free to put those in. I know John is gonna be monitoring those, and we'll get to as many as we possibly can. If we can't, John, or Alex will probably be reaching out. Feel free, you can always reach out to me directly as well. Always happy to help. So with that, let's get started. So in true Bill Staten fashion, I thought we would start this with a political cartoon. So given that the first debate is coming tonight, I thought this was probably the most appropriate slide to start off with. So if you have any high expectations of the debate, you should let those go. I think it's better off, grab your cat, hold it tightly, go out on the front porch, turn the TV off, get some peace and quiet, enjoy some serenity. And I think tomorrow morning you will wake up in a much better place than if you were to sit off. Related to politics, though, I'll start from a macro standpoint. One of the things that I know is pretty concerning for people is the amount of debt. Here I have a chart of the deficit. I thought it was a little bit more present in terms of where things are, how they change, but I did want to address this because it is one of those things that's at the top of mind of voters' minds. On this chart, we have from going back to the 70s, the rolling 12-month deficit, and it just kind of goes throughout time. This green area is the Clinton administration when we had a surplus. Then it kind of goes through. The gray bars in here are the recessions. So typically what you see is deficit spending, the traditional Keynesian economics. So here is the deficit normalized as a percentage of GDP. So within this first gray bar, go into a recession in the 70s. The ones in the 70s were pretty nasty. You go forward and we deficit spend, helps us get out. We move along. Same thing. We kind of get out. We come back up. 2008 happens. We spend quite a bit more. The TARP package. A lot of you probably remember this very vividly. It was a scary time. But then we come back and we start getting back to a normal course. Recently, with COVID, it's been very interesting in this respect. We spent a ton of money. The economy closed, right? No one has any issues. I think most of us understand what was going on. But the problem that we are running into right now is this number right in here, where we are still spending as if we were in a recession, and we are not. We're out, right? And this is a big issue, I think, for a lot of voters. It's something that we keep top of mind. It's something that we hope politicians will address. Not a whole lot of us know for sure to what degree that'll be, but it's one of those things where we need to get a handle on that. As we think through what'll help with that, there is one thing, the bright spot, and I think that is the US dollar is still the world's reserve currency. So it definitely elongates, buys us time. It's not something that I say is a good thing, but just to rest mind at ease that people still want US dollars. There's still this demand for being able to trade internationally, for safe haven assets. The faith of our economy rings very true throughout the world, and it's still one of the bright spots that I think people have. The next slide, the next couple of slides, you've probably seen in some form or fashion. It is the S&P returns as it relates to who's controlling the White House. This goes back to the 50s. And you see the red bars are inclusive of a Republican president. Blue bars are when the Democrat is in the White House. And what we see is this. There's not a whole lot of rhyme or reason. Both Republican presidents have up years and down years. Both the Democrat presidents have up years and down years. It just kind of goes along, and there's not a whole lot of specific correlation that you would be able to glean. Another way of looking at this is by dissecting the actual government. So here we have on the right, or excuse me, on the left, just when a Democratic president is in versus when a Republican president is in. So very similar to the last one. The next we have the Senate controlled by Democrats, Senate controlled by Republicans, just around the B. C is the House control. D is if one party controls everything, all of Congress and the White House. But the thing that I think is most interesting is E, and that is when government is split, returns tend to be the highest. And this reminds me of a conversation I had with a gentleman in the Dominican Republic. And I think it's very interesting. It really made me feel a lot of gratitude. And it's this. He said, in America, we are all very aware of the polarization, and we are very much understanding of how divisive things have gotten, and we view that as bad, and I think it's better if we work together. He was from Haiti, and he said, we have a one-party political system, and the problem with that is there's a ton of corruption. There's no checks and balances. So if there is one bright spot, and I think this chart kind of illustrates it, is when you do have two parties that are split and controlling it, it helps keep each one in check. Not that one is always right, not that one is always wrong, but having that balance of power is definitely beneficial, particularly as a market, because I think the majority of the CEOs that are running these companies are incredibly bright. They have wonderful teams. And as long as they can count on what the rules of the landscape are going to be going forward, they can do some amazing things and really create value for their shareholders. Keeping in mind, or keeping the theme with this long-term mindset, I wanted to go over some of the impact of dividends over time. So this chart is going back to the 1990s. It shows the impact, or it shows the price return of the S&P in blue going up to present day. And then it shows when you add on dividends, how much more that adds into the return profile. And the big takeaway here is over this time period, you've basically doubled your money when you add in the impact of dividends. And that's super significant. Going into the current environment, where are we at? So quick market update. This chart is for the last year. For the most part, large caps have outperformed small caps. We see this with the Russell 1000 versus the Russell 2000. But more interestingly, I think, is the split even within large caps. So here we have the market cap weighted index versus an equal weighted index. And it's really interesting. Again, this is only over a period of 1 year, but there's a difference of roughly 15%. And of course, most of you probably know this is driven by the flavor of what they call it, the flavor of the day of what they call it's the Mag 7 or FANG, or there's all kinds of acronyms, but it's really these top weighted names. And it's interesting, I found this chart with another gentleman that I follow. This is the weight of the S&P 500 in the top 4 names over the years. So going back to the 60s was the last time that we had roughly 4 names account for 25% of the market. You fast forward, and that's roughly where we're at now. The thing that I think is interesting, though, is that path that the market takes after it reaches that peak. And I had a gentleman last night, I was at a business event, finds out what I'm doing. And he says, you know, I've really been thinking about buying NVIDIA. And of course, in my mind, I thought to myself, I bet you have. Everybody else has been thinking about buying NVIDIA as well. The thing is, it's not about what the opportunity was the last couple of years. It's about where that opportunity is going forward. And I think this chart specifically really illustrates that there's a lot of opportunity in the lower cap names. If you're betting on the big names getting bigger and bigger and bigger, that's not how things have tended to trend historically. So if we look at this chart from 65 going to the very bottom of the mid 90s, basically what happens in that situation is smaller cap names where the valuations more or less got left alone, that dispersion tends to correct itself and it gets back more in balance. Again, as I was saying, most of this is AI driven. We show the number of mentions of artificial intelligence throughout the media, and it's pretty steady. It's gone around. I think it was existing when I was a kid, and you know, the science fiction movies, but it really took hold last year, particularly after NVIDIA released earnings. And that's where we see this large spike in AI mentions. And I can tell you, in all honesty, the earnings calls we listen to, the earnings transcripts we read, the company presentations we go through, everybody is talking about AI. And it's not just chip companies, it's retailers, it's banks, it's going to permeate, and it most absolutely will be impactful. I think where we are at in the AFC portfolio, we have some direct beneficiaries. A lot of people hold Digital Realty. Accenture, we'll talk about a little bit later, was a more recent purchase. Microsoft's an easy one to kind of think about as of late. But there's a lot of companies also that we hold that are going to be what I'll call AI adjacent. And what I mean by that is Walmart is incorporating AI into their operations to get more efficient, to find a better way to be profitable. Some of the financial institutions we hold, whether it's Ameriprise, Bank of New York, again, incorporating technology. And while we're at the forefront of how artificial intelligence is being perceived, at some point it'll just become normal course of business. And yeah, we have computer programs that are running in the background and helping us figure out better ways to do these things. So as we get into the company side of America's Finest Companies, I wanted to highlight the framework that Bill and I have been working on together for the last 7 years since we started managing this portfolio together. Foundational at the very bottom of this is the dividend track record. 10 years of dividends is super important, and that is still the case. If you think, and the reason is this, if you think about what a company goes through in a period of 10 years, There's highs, there's lows, and if you're increasing that dividend every year, that really speaks volumes about your ability to run the company conservatively, to have it with a shareholder mindset, and to be forward thinking and looking at what you need to be doing. Versus some companies that tend to be, I won't call it short-term focus, but sometimes companies will be focused on what I'll call empire building. Let's do as many M&As as we possibly can. We're not going to pay a dividend out. And ultimately, you end up with some companies that really are ran inefficiently. On top of that, we have financial strength. Having a balance sheet gives you lots of flexibility, allows you to capitalize on opportunities when they come. When things get a little squirrely and the economy's not doing so well, it helps insulate where you may be. You get above that, you have the company's moat. We've talked about this numerous times. A moat is similar to the castle where it helps insulate you. Think of it as a competitive advantage. Does the company have something of interest that is very hard to replicate? Does the company have some unique product or service that will keep people coming and give them what we hope are abnormal profits year after year? And then these all roll up into the top and the intrinsic value. And this is where Bill and I really had some great conversations in terms of, we think the company's worth $20 and we can buy it at $10. This is a great deal. Or we think the company's worth $20 and it's trading at 30. Let's hold off and wait for the price to come back to something that's more reasonable. Going from this framework, I thought it'd be good to recap some of the more recent trades that we have started to implement in the portfolios. And I want to start off with the most recent one that's actually pretty familiar with the AFC portfolio, and that's AbbVie. As you see at the bottom, the dividend track record of 52 years. Their leverage is incredibly low. They got $18 billion of cash on the balance sheet. They have drug patents. They continue to dominate the position. I'll pause here for a little bit. One of their big drugs is Humira, helps with rheumatoid arthritis. And one of the fascinating things we saw with AbbVie is in Europe, that patent expiration happened, but the sales didn't decline nearly as much as they should have, given generics could have come into the market. Their sales pipeline and their salesmen did an amazing job of continuing to build out relationships with different physicians and hospitals to keep those sales coming. We think that's going to translate into the United States. Even if it doesn't, they have two other drugs that are coming into the works that are basically this equivalent of Humira 2.0, so to speak. And so I think that gives them a huge insulator for some of their revenues, and not to mention the other list of drugs that they have that are coming to market. At the top, again, we're looking at the price, the discount we can get. We had our initial price target on this was a little over $200, and it has a roughly 3.5% yield. Just prior to that, we bought L3 Harris. L3 Harris is a defense contractor that was combined from L3 and L3 Harris. They combined. They do smaller components. So their dividend track record is 23 years. They've been increasing their margins, increasing their profits, paying down their debt. And in this space, there are incredibly high barriers to entry. Not just anyone can become a defense contractor, especially at someone at this size. When we started going through and looking at the details of how management was looking to transform the company and really try to drive innovation, we ended up feeling pretty good that our price target we have is at 271 at the time, a little over 2% yield, not the highest that we want, but one of those where we feel they'll be able to increase it. And then lastly, I'll talk about Accenture. This was a trade I wish it had worked out better. We're still holding it, still a lot of conviction behind this name. We bought this, I believe it was, started buying this back in February, March timeframe. They've been paying out a dividend, increasing dividend for 19 years. They actually have negative leverage. A lot of you are probably thinking, like, what in the world is negative leverage? Negative leverage is this. If I have $1 billion, typically we look at leverage like this. If I have $1 billion of a debt on the balance sheet, I have $500 million of cash. My net debt is $500 million. If I have negative leverage, that means in this case, I have, call it $70 million of debt, a very small amount, and I have billions billions of dollars of cash on the balance sheet. I could pay that debt off as soon as I wanted to, and I still have a ton of cash on the balance sheet. Just a pristine balance sheet. The size that they've become and the intangible assets that they've delivered and accumulated culturally year after year really puts them in a great spot. And where they really shine going forward is being a consultant to all of these other large Fortune 500 companies when it comes to artificial intelligence. It's really, as we showed in that chart a while ago, that pickup in interest has really started only within the last year, where people realizing, my goodness, this really is something to be paying attention to, and I need to make sure I figure out how to do it. Again, this is a name that we have a lot of conviction in going forward. The price hasn't necessarily reflected what we had hoped it would, but we don't get all of them right, and the timing of it isn't something that we want to focus on. It's just not in our wheelhouse. Our price target on this is 436. It's got a 1.7% dividend yield, and I think these guys will really be able to increase the dividend yield as well. So that's where my comments end. Feel free to put some in the Q&A, and then I'm going to turn this over to Alex to talk about how we serve some of our families.
Yeah, thanks so much, Brando. So, we talked a lot about individual stocks that we're researching and managing money. I want to just talk real briefly, give a 30-second commercial for kind of the other services that we provide. I know some of the participants on the call have taken advantage of all of these or some of them, and many haven't. So just want to highlight a couple items here. So particularly on the planning side of things, a couple of unique things we do for clients. Number one is the cash flow and retirement planning. So helping clients map out their spending, the future income that they'll receive, and trying to create a portfolio that matches that. We also have Whit Wilkes, who's an estate planning attorney by trade. He's not a practicing attorney. However, he and our team can review your trust and estate documents, to save you the hassle of calling up your attorney and visiting them. We can kind of give you a high level view before you, draft those documents with your attorney. So once again, we don't draft the documents, but we can review them, make suggestions, and then kind of point you in the right direction to take action with the trusts and estates. On the investing side of things, obviously, individual stocks is sort of our bread and butter, but we can also add individual bonds, and build customized portfolios for our clients. And the last thing I'll touch on is the financial education and intergenerational planning. So, a lot of the families we work with, they will have their children speak with us, so we can serve as counsel to younger clients who maybe don't have the minimum assets today, but we can provide a good foundation for them for saving long term. So that's something we always encourage our clients to take advantage of.
Awesome. Thanks, Alex. So this is a good opportunity. If anyone has questions, so if you don't know how to type the question, so at the bottom of your screen, there will be a Q&A box. And so while we're waiting for potential questions that you guys have from what Brando said or what Alex just covered, one housekeeping item that I wanted to mention. So we know we asked you to meet, on this Thursday at lunchtime, and to thank you and to show our appreciation for you guys coming into this webinar. You should have received a DoorDash gift card via email. And so hopefully most of you guys right now are enjoying your lunches via the DoorDash gift card. But if for some reason you didn't receive it, please feel free to reach out to Julie directly, and we'll make sure to send that out your way. Let's see. Brando, I think you did a good job with your presentation, man. I don't see any questions in here.
I don't know all about that. They're probably just like, oh my goodness, I'm not really sure what that guy was saying.
Well, while we're waiting some, Brando, I actually have a question for you, if you don't mind answering it. So,
yeah.
As you know, you turn on the news, everything you hear is super fear-driven.
Yeah.
And specifically, what are we talking about? The economy, the markets. It's almost like there's never positive information on the news.
Yeah.
Yet the market keeps on ticking up. And so I know you don't have this crystal ball, but what's your thoughts on kind of the current valuation of the market And where do you see things going in the next 12 months or so?
Yeah, that's a good question. Two things, I guess. The first, I would say, I think returns will be good, honestly. I'm not always the most optimistic person, but as I was talking about earlier, the market has ran so much with some of the higher cap names that I think there's a lot of opportunity, particularly in the, call it the bottom half of names that are really well ran, that have kind of gotten forgotten about. And I think that's where we're finding some opportunity. Another issue I'll throw in the mix, and not to make this too confusing, is interest rates. So interest rates have been a huge component of how returns have developed over the last couple decades. I think interest rates will probably continue to stay where they're at, certainly through the end of the year. Right now, the market is pricing in something of a rate cut in December that may or may not come to fruition. But I think as inflation starts to get tamed, the likely scenario is interest rates will eventually get dropped. And as interest rates get dropped, that kind of lifts all stocks as the opportunity cost. One interesting statistic, and I ran this a couple of years ago, it's pretty much true throughout time, regardless of index or market. But it's this: roughly 90% of the time, stocks are within 10% of their all-time high, right? And I think it's fascinating to hear that statistic when you put that in light of how the media puts out this fear-mongering news of, we're going to scare the bejesus out of you to try to get you to continue to watch and click and like and subscribe to whatever it may be. But the fact of the matter is this: capitalism and the US economic engine is super strong. There are a lot of smart people. The beautiful thing about it is every day we all wake up and we all make a decision on how to allocate capital, and it gets better and it gets better and better. And ultimately, that's where the market is going to be going. So probably a little bit longer of a winded answer than you're looking for, but hopefully that answers it.
No, that's great. And I have a side question. So I actually just got one in the chat here. And you sort of touched on it, Brando, but the question is, you talked about the amount of debt out there.
Yeah.
Can you talk about your thoughts on the money supply, M1, M2, etc.?
Yeah, no, that's good. I almost wonder if was that Bill Staten asking that question? He loved to talk about the money supply. It's interesting. I think Bill and I had differing viewpoints on the money supply. I think the amount of credit that is out there has started to come down, and that's a large part of that is a function of the banking sector. We've seen, as interest rates have increased, some banks have tightened their balance sheet. Overall, the money supply is still fairly large. It's started to unwind itself. The shadow banking, there's money supply is very different now than what it used to be 30, 40 years ago. And what I would say is this: there are a lot of other avenues for credit to get injected into the system versus the traditional banks. You have private equity funds and you have the repo market. There's lots of other areas where this stuff can creep in. Ultimately, I think what the market comes down to is how available is credit. Credit gets easier, or we'll call it money. Money gets easier to get. That tends to promote economic growth. There's some element of inflation into that as well. As it gets tighter, things tend to get drawn down. One of the areas we're looking at specifically, we're keeping an eye on, is commercial real estate. Given what we just came out of from COVID, the commercial real estate is an issue that will affect banks. There's some regulation that's been going through Congress as it relates to banks and capital requirements. I think this was about 2 months ago. All the congressmen got together and they said, let's start over. We have no idea what we're doing. So in the end, the money supply isn't going to be a huge driver. Again, I think it's going to come to the availability of credit, and are smart people able to tap and finance the projects that they want to. and I'll just make one last comment. I remember this would have been probably like 2012-ish. We had just come out of the great financial crisis. Interest rates were artificially depressed, and everyone knew it. Nobody could make any money on a savings account, but eventually you get to 2012, 2015, people started to capitulate and say, look, I've been holding my cash making next to nothing, and I realized that I got to invest it and do something. And they finally got to this realization that interest rates were just going to be low and low and low. I think we're a little bit at that same inflection point on the other side, where interest rates have come up quite a bit. People have started to slow down those projects and capital spending, but as that mindset reassets to interest rates aren't going to be zero, there is going to be some cost, which I think is a good thing. I think there should be some type of risk allocation going on in our mind. I think we'll see lending and the credit and those markets will get greased up and things will get back to normal again.
You know, Brando, there's a couple industries right now that everyone's talking about. And so I actually have two industry related questions for you that we can kind of do rapid fire here. But the first one is, given the rise in value of Eli Lilly, do you have a focus on Ozempic-like drugs and their applications/popularity?
We do. So Eli Lilly GLP-1 drugs are something that we've been paying attention to. It's interesting. The Eli Lilly, I won't call it a phenomenon. It is a pretty interesting drug. There's a lot of speculation in terms of where it's going to go. When you get into the pharmaceutical space, that is one of the few companies where the valuations have really shot up. And I can't help but think that, as you can look at it from a risk mitigation standpoint, like just it's part of the market, but in terms of the impact it has, it may or it may not turn it into something. I think it's easy for people to get really excited about this weight loss drug, and then that gets extrapolated into so many other industries. Pepsi is going to stop selling more pop or soda, as they say down here in the South. Airlines are going to have greater margins because people aren't going to weigh as much, and fuel costs aren't going to be as high. Some of them get really far stretched. At the end of the day, I think there's a lot of unknowns still with a GLP-1 drug and how that's going to impact the market. It's not really something that we're convinced yet to make an active bet and say, yes, this is totally worth the premium it's getting trading at.
Sure. And then the second industry, so you had a great slide on this, Brando, just about AI, specifically on the investment side. But one of our clients asked a really good question, more on the back end process for you and your investment team. And so it's curious on your perspective of the role that AI will play in market mechanics themselves. For example, using AI to predict, buy, sell, and timing the market from the wealth of info available online. Is this a risk for investors currently? And does Navarre use any kind of AI in our management process?
No, that's a great question. Wow. I mean, yeah, keep them coming. So as it relates to AI, what I'll say, the easy question is we are utilizing it here on our side. It's probably not the way our clients think about it. The simplest way is I can go into an earnings transcript. So company releases their quarterly earnings. I go into a transcript a couple hours after it happened, and I can interface with an AI software, give me the top 10 questions that were asked by Wall Street analysts, and it'll give me something like that. So it's more in how we gather data and how we get really efficient at it. Bill and I we would have these talks a lot. We still have them every now and then. We get together for coffee. But when he started off in the industry in the 70s and going through the 80s, his problem is very different than what we have now. And what I mean by that is just getting information from his perspective was really hard. Like you really had to go around and try to collect. It took a lot of effort to get the data. He's got stories that he'll tell anybody about going to the library, hiring an intern, and going through these annual reports to calculate out like dividend increases for companies, right? All of that information now, the problem I have is way different. All that information is very readily available. We can run screens and a couple of algorithms, and we can get a list of a ton of companies that have increased it 10 years. And for the most part, it's going to be pretty accurate. The second part of your question, I think, is super relevant, and I think it's dangerous, almost not dangerous, but people should slow down and really think about this. If we really think about it, AI is basically just a souped up high-end software, right? It doesn't know anything that isn't already out there into the world. It doesn't know anything that we haven't told it about, right? AI is not able to go and pinpoint where black holes are going to be. We don't know, and therefore it's not going to know. So all of that information is based on historical perspective, historical data. Everything that investors care about is the future, right? And so there's still going to be this element where you have to have some logic, you have to have some common sense to really think about what are profits for a company going to be as you go forward. And I think that's still going to be incredibly important. I don't think not to say that AI is not going to help. It's definitely going to help process some information, and we may come to different conclusions, or we may get information that helps us come to different conclusions. But in terms of being able to flip on our computer, hit this switch, and it goes, I don't see that happening.
Yeah, Brando, I guess when I think of AI too, I think of productivity gains, right? And
Yeah,
a lot of people have questions about, does productivity and efficiency end up impacting the labor market in 3 to 4 years, right? Like is that tech bubble, whether or not you want to call it a bubble, but does those efficiencies and productivity lead to more, let's just say less people doing more?
right. No, John, you're totally right. I mean, so we'll take a huge macro viewpoint of this, and throughout time, if you look at any technological revolution, the telephone, probably an easy one. The telephone displaced carrier pigeons and people on horseback, the Pony Express going from town to town, and the telephone comes, and now you can make this call. And it doesn't, that person who's riding the horse from one town to another town delivering messages, that doesn't exist. But what that means is he has 6 more hours during his day to find something and do something more productive. To your point, John, I think there will be some people that are mad about it. There will be some people that have to relearn skills. I think in the grand scheme of things, though, it's going to make us way more productive, way more efficient. Our economy and we've done this for hundreds and hundreds of years. We will evolve, we will adapt, and we will get better. It's just one of those things. It's not going to be this end all be all. Good questions though. Yeah, this is probably way more. It's way more fun for me at least than going on their slide deck.
Yeah, we had one more question in there. You want me to take it?
Yeah, go for
it. Someone asked Bill's ideas on evaluating potential stocks and for investment, and that he was very reassured by Brando's comments. Can we assume that Navarro is following a lot of his lead? I think to answer that, and anyone's welcome to jump in as well, the answer is yes. I mean, the framework was built a couple decades ago. The framework won't change. The process is still the same process. The portfolio team still has to operate with those constraints on the dividend, the moat, the intrinsic value being attractive. So I'm still seeing Bill quite often, talk to him yesterday. I know Brando and the portfolio team sees him for coffee from time to time. So while he's not in here with his joyful attitude every day, his impact still carries on, and we're still interfacing quite a bit with Bill.
Yeah, I'll just add on to that real quick, John. When I alluded a little bit to it earlier, when I first met Bill, we had an amazing conversation. I was telling him about trips I had made out to Omaha for the Berkshire Hathaway conference, and we started going through these old books that we both read and things like that. And it was really, it was one of those things where you walk out and you're like, holy smokes, I just found my long lost brother. And so how Bill and I were managing money together was pretty much in sync. I think I love Bill to pieces. Some of the computer programs that we were using to help solve some of the issues were a little bit, he'd say, you know, here's what I need, you handle this. But in terms of the philosophy, how we look at the world, how we view investment ideas, it was already very similar. I mean, pretty spot on. I don't think you can clone anybody, especially somebody as charismatic as Bill. But yeah, that whole process, I mean, as long as I'm still at the helm here, is definitely going to be continued on going into the future, mainly because that's how I view the world as well.
Yeah, and I think, we really pride ourselves on working as a team, as you can see. And so I hope everyone in this webinar knows, if there's any follow-up questions, any questions that we may have missed, the four of us are certainly available. Please reach out to us directly. And, we can't reiterate this enough. Your continued investment with us, it's something we don't take lightly. We take a lot of pride in stewarding the retirement funds of individuals and families. And so it really is our honor to work on your behalf. We look forward to many more good years of AFC performance, but also hope to add these other services as well, like Alex was talking about with financial planning, to hopefully give you guys comfort during the ups and downs of the market. And so again, if there's any other questions, please feel free to reach out to us. If you haven't received your DoorDash gift card, shoot Julie an email and we'll make sure to get that out to you. But thank you so much for your time today, guys. And hope everyone has a great rest of their Thursdays.
Thank you.
Thanks.